Benefactor underwriting for this broadcast has been provided by a grant from Republic Bank. The power of red is back. Major underwriting support for this broadcast has been provided by grants from New York Community Bank, M&T Bank, Perfect Building Maintenance, Customers Bank, Collins Building Services, Marks Paneth. Additional underwriting support has been provided by grants from AmTrust Title, Bank of America, Capital One Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, New Banks, Meridian Capital Group, Ocean First Bank, RPW Group, TD Bank, the One Stop Property Group, and these friends. (2022). What does it look like? What is this? Where do we stand with residential rental apartments? When the pandemic came out, people were leaving the city, rents were down, concessions were up. Where are we 2 years into the pandemic? Where is the market? Is it good to own property in New York City as a residential rental owner? I don't know the answer, but today I've assembled this group of business leaders to provide their insight on the residential rental market in New York City. My guests include Stephen Krasman, who is the Chief Operating Officer Counsel at Slate Property Group, David Schwartz, who is the Managing Partner at Sugar Hill Capital, and last but not least, from sunny Miami, Florida, we have Eli Weiss, the Chief Bottle Washer and Principal at Joy Construction. So, Eli, since you abandoned everybody and at least you were nice enough to join us in sunny Florida, it's only 14 degrees today. I just don't want to have any guilt over there. Somebody who's been on my show numerous times said to me, I am not planning to build anything new in the residential rental market, especially without knowing what's going to happen with 421As, with the situation with the new controller, with the city and state. What's your thoughts about new developments, market rate as opposed to affordable?
So it is ironic that I'm, recording this from Miami, as we did see a lot of people leave New York, but as I'm sure Steve and David can tell you, probably all of our portfolios are at, back to pre-pandemic occupancy rates. So, I think this narrative of people leaving New York and not coming back is sort of a narrative that I'm following. I came down on a Monday. I'll be back on Thursday. I think what we saw is that, like any business, there are inherent risks. Obviously, the pandemic was one that was very hard to quantify, but there have always been political risks when it came to multifamily. It's a regulated business in New York. And I think we went through a very acute period of having, significant legislative and regulatory changes, a pandemic. Quality of life in New York City has definitely changed. Most people would say not for the better over the last few years, although I think there's a lot of optimism with the new mayor that would improve. But I think what we saw is, there are risks in the multifamily space, as there are. People used to think that, multifamily housing in New York was a very simple business and it was like buying a treasury bond. It's not. It's a business. It's a business that, has impact from social and political risk. However, I think when, we move the discussion further with Steve and with David, what we'll see is that, even despite all of the challenges that I just mentioned, we've seen New York City come back very strong. And I think there's a very positive feeling in New York right now with new political leadership. We're seeing a lot of people who never lived in New York before say, now I want to be in New York. So, the challenges are always there, but I'm generally very positive about the state of the market.
So here's the question for all three of you. Is it a tenant's market or is it an owner's market today in residential rentals? Stephen, David?
even before the changes in the rent law, we always had a theory that a rent stabilized tenant is the owner, but a free market tenant, generally the building is owned by the landlord. Um, the rent regulations that changed in June of 2019 just reinforced that concept. And to speak to some of the things Eli said, yes, New York has definitely come back strong. On the free market apartments, we're starting to see rents at pre-pandemic levels, if not better. But we still have the rent ceilings for our rent stabilized tenants, and still the many challenges that exist post the changes in the rent law in June of 2019.
What about the renovations? When 2019 came in, the MCIs changed, the improvements changed. How do you handle, especially David, since you have a larger portfolio of older apartments? Steve, you have some of them. How do you handle the improvements to the properties? Because you couldn't even do a condo conversion or a co-op conversion. You were stymied. How do you handle that 2 years into it now?
Very delicately, and generally we do what we have to do to maintain the property and create a safe and secure environment for our tenants. But there's only so much money you can or so much water you can get from a rock. That's definitely our challenge. It's is the juice worth the squeeze argument? Bottom line is we have to do the right thing legally and also for our tenants and try to maintain a good reputation of being a good landlord where we can. But there are challenges just given there's a certain amount of money available. I guess one of the things that helped us, believe it or not, is COVID. Because for the last 2 years, tenants were nervous to have one of our maintenance workers go into their apartment. So the number of calls really came down dramatically. Now that's starting to change, and we're back into an environment where, and where people are looking for repairs, not just of the current issues, but of the issues that accumulated over the last couple of years.
Stephen, when Slate started, they started buying older buildings, okay? Over the last number of years, they've been more in the development of newer buildings. Would you buy any buildings today? Because a lot of properties, there are things trading in the market. What's your opinion on that? Both David and Steve.
Yeah, no, we're extremely bullish on multifamily in Manhattan and prime Brooklyn and Queens locations right now. We see concessions are really burning off in prime areas. Rents are up to pre-pandemic, levels. We're having occupancy in the high 90% range. So we're very bullish. We're actually looking actively at a few larger assets, and the development pipeline continues for us. So obviously seeing where 421A or the next iteration of it shakes out is critical, because you really can't pencil new development deals out without some type of program. But we're extremely bullish on New York. We think, despite the little Omicron bump in the road here, like we really do feel like New York City's back. Go try to get a restaurant reservation at a prime West Village restaurant. You see, everyone wants to be living here. So we're extremely bullish.
I mean, Eli, you've done more of the new developments. You really didn't buy older buildings. I mean, David and Steve, they bought older buildings during the period of time. Many of them market rate apartments, so it's a different world. How are you involved, or are you planning any new residential developments?
I am. I'm filed plans, and I'm currently in demolition on a 465 unit, 75-25 building on Tillery and Prince in Fort Greene. It's a building that was a former self-storage building, which is ironic because when I bought it, the highest and best use was clearly residential. And as times changed in today's market, storage is one of the hottest facilities, but I rezoned the property. I acquired air rights from the adjacent NYCHA facility in the first transaction of its kind in the United States, where a private developer acquired air rights from a public housing agency for a private site. And we're building a 465 unit rental. We are on schedule to vest into the current 421A program, which I think is crucial. But I think, this week, everyone in our industry, had a sigh of relief when Governor Hochul made it very clear in her State of the State that, extending or coming up with a new 421A program was something very high on her agenda. And I think, having a more functional relationship between New York City and New York State is going to be very helpful in that process. So I'm pretty confident that not only, in the multifamily sector as it stays today, but I think we are definitely going to see some sort of new iteration or extension with slight changes of the 421A program. And, while no program is ever perfect, it's one of the major tools that creates not only affordable housing in New York, but housing, right? I am in the affordable housing business, and people always talk about the shortage of affordable housing, but it's a two-part story. We have a housing shortage for people who can afford, higher market rents, and we also have an affordable shortage. And what the 421A program does, it seeks to resolve both of those issues. So I'm pretty hopeful that, with this current leadership, we're going to see some sort of new iteration or continuation of the program.
This is a question for both Stephen and David. You're, in addition to being in the development, you're also in the lending business, and you've been lending on people's purchases of acquisitions of residential rental. As a lender, how do you look at the market? Where do you see, because it's a different market than being a developer?
Being bullish on New York City in general, we like, obviously, you're taking a safer position as a lender. We've seen some of the deals that we didn't work out for us on the development side. Now we see them coming back on the lending side, and we're extremely bullish because we know the assets, we know they're in great neighborhoods. Obviously the sponsors are a critical element to making sure they get done. We love the business. We've been extremely active in the space, and we plan on continuing to be in the coming few years.
David?
So our lending business is probably a little higher yielding than what Slate does. So they're more heavily involved in construction. We haven't seen as many opportunities on just plain lending on the residential side in New York City because the banks are extremely aggressive and do a very good job in that area. We do see some deals, but they're generally distressed deals where, due to the changes in the rent law to a large extent, the deals are underwater, or there's not as much capital as perhaps the borrower thinks there is. And we tend to get involved both as a lender and maybe even in a form of like rescue capital, where we can put in a little bit of equity, whether it's pref or common, in order to help manage the deal and get it back into a position of stabilization, not to be confused with rent stabilization. But yeah, we're not as active in the construction arena as Slate. It's something we are actually involved with and trying to get more involved. But most of the loans we're making have a really big story to them. And generally that means there's some distress. But we do like that space. And similar to what Steve says, we're very knowledgeable about New York City real estate. So we like to be involved in areas where we have a lot of expertise.
What about the condominium market, the new construction for condominiums? Where I know Slate had originally, I'm not sure how many developments you have right now, but I'd like to address that subject for all three of you. Stephen?
Yeah, we've always had very limited exposure to condominium development. It's a different business, and timing is so much more critical to the execution. In the rental development world, you can hold an asset much longer, go through different business cycles. Condos, it's really about timing and when you can deliver units. We do have a condo development, a kind of boutique condo development in the West Village that we're very excited about, but it's really limited exposure. And I'd say our focus is much more on affordable housing right now, and then just general market rate development that's in our pipeline.
David, a couple of years ago, you bought a property called One Prospect Park, and you converted it into an assisted and independent living facility, correct?
We bought it when it was an assisted
Right.
living facility, but we actually converted it to residential condos.
So let's talk about what everybody's thought is with regard to the independent living and assisted living. Because last week, a press release came out about Sunrise on 56th Street, which really opened up about a year and a half ago, but they said that the official opening took place last month. And one of the factors at the Sunrise on 56th Street and Lexington Avenue is that they have an affiliation with Northwell Health, where doctors can come directly into the facility, which is a little different than the other assisted living has had in the past. Since it's a rental complex, which is something that all of you are involved with, what's your thoughts about independent living and assisted living? David, Steve, and then Eli.
Honestly, I don't have a lot of strong views on that. I'm not as experienced on the assisted living facility, other than my own mother was in one in New York City, which was challenging to get her in there. But yeah, they are run like rental properties, but it's this very specific asset class, and the units are built specifically for single members. So it's more like an SRO, in my opinion, without the shared bathroom facilities, but it's not my area of expertise. So I'll defer to the other gentleman here.
Right, Stephen?
Yeah, we've looked at it briefly in more in the affordable housing sector, but we really haven't played in the kind of Manhattan.
I mean, you know what? It's basically a hospitality asset. And have you
I've been in the
thought of these-
hospitality business, and I've also done senior housing in New York. A senior housing that's part of, you know, an affordable component. And, you know, I agree that it's slightly different. You know, the focus is not just on the housing, it's more specific to the services and the social services, and the specific design and the way that the building functions obviously needs to meet the tenant population. You know, that said, I'm always a proponent that, you know, in a city like New York, where growth is the ultimate, you know, goal, you know, cities in decline generally tend to have decline in quality of life, and cities that are growing generally tend to provide good quality of life and better opportunities for their residents. And I'm always a proponent that all housing, so long as it's for residents who actually live in New York, is good for the city. And, you know, it's a diverse population. It's a population where people are living longer. So, you know, assisted living and anything for seniors makes a ton of sense. But, you know, to me, it's a form of supportive housing where it's not just the housing, it's the support that comes with it. I believe that the Elliott Spitzer and Related project on the corner of 35th and 10th and Hudson Yards has a large assisted living component and senior living component. So clearly, you know, there's a market for it. And as, you know, people, as David said before, you know, if you live in New York and you want to get your parent or a loved one into an assisted living facility, there's not a tremendous amount. So, you know, obviously I think that that product has its place. It is a very niche part of the market because of the services are not only, you know, typical to residential, they're medical, and that's a whole different ballgame. So you're in the medical hospitality business, but it's a needed asset class.
So where are the opportunities in the residential market for 2022 and going forward? David?
Sure. I mean, we have seen a very big pickup in institutional interest in New York City multifamily housing, including rent stabilized. We have, you know, raised some new capital, and we're back in the market buying buildings. It's really coming from the fact that, you know, you're basically getting an annuity stream. That the rent laws for rent stabilized properties, I hate to say this, but I don't think they can get much worse. So you're kind of at the bottom. And if you can buy attractively and finance attractively, you can lock in a pretty good annuity stream. It's not as true on the free market. Those have different opportunities. I guess the biggest challenge we face on free market is just, you know, if the regulators continue to make changes, including, you know, good just cause eviction, which is, in the opinion of many landlords like ourselves, it's really a form of universal rent control, which will also change the dynamics of pricing. But we do think there are opportunities, similar, I think, to what I've heard at this panel, that New York City presents a lot of open opportunities in multifamily.
Stephen?
Yeah, I think we here at Slate echo that sentiment. I think we have a lot of institutional interest for multifamily assets in Manhattan currently. Again, I think 2019 maybe scared a few people off, but then you learn to get kind of comfortable, and we see a lot of bullish attitudes toward where rent growth is going to be, and we see it focused in the prime areas of Manhattan currently.
Eli?
You know, I think that as difficult, and I agree with both, you know, Stephen and David, the rent laws, you know, are as difficult and challenging as they've been in the history of the business. COVID, you know, did to occupancy what has never happened in New York. I mean, I had buildings, market rate buildings in Manhattan that were 55% occupied. You know, you can't underwrite to that. You can't, you know, there are no solutions. There are no Microsoft Excel solutions to 45% vacancy. And we saw it through. And you see people still want to live in New York. I think you still people wanting to deploy capital in New York. I think you're seeing a different demographic. I think what we saw out of the great financial crisis of 2008 was an influx of TAMI tenants into New York. So the population changed. It became a bit more balanced. I think what we're going to see in 2 to 3 years from now is that this event also caused a population change and will balance things out so that New York is not so dependent on one particular class of tenant. I think had we done this show 3 years ago, and I think I did with Martin Nussbaum, we spoke about how our buildings were occupied disproportionately by foreign students. And that has gone down tremendously due to COVID, but there's been a new population that's replaced them. So I think that the evolution of the New York City residential market happens. This was definitely on the most difficult of evolutions, but I think that coming through it is the ultimate testament to the market, which is we've weathered this. And I can tell you that in my career, this is the hardest time I've ever had when a friend calls me up and says, my daughter wants an apartment in New York. Do you have anything? This is really one of the first times where I say, I really can't help you right now. I'm not being difficult, but there are no units.
Yeah.
So here's a comment. You were talking about the show you were on with Martin a number of years ago. One of the topics I would have spoken about then was co-living. What's up with co-living today? Steve, David, or Eli?
We explored renting some chunks to some co-living operators a few years ago. I just don't think we've seen that through, and I think it's generally people right out of college, maybe a couple years into the career. I co-live right now with my family, but they don't pay rent, so it's a slightly different situation. Given rents where they are and some of our buildings, the occupancy where it is, we don't see a need to go kind of explore those other opportunities at this point.
Yeah, I always felt that co-living was, extrapolating the quote unquote algorithm a little too far. I think people looked at co-working a little bit differently. It was office space. There were always people in your office space that you didn't know so well, that you just said hello to. It's a little bit different when you're living with them and sharing a bathroom and sharing a kitchen. I think we're not there yet as a society where that becomes a norm. There have been changes in the margins within industries like co-working, micro rooms in hotels, like what you've seen out of the Moxie, rooms that are 150 square feet. Those are changes in the margins. To me, co-living is, a fundamental change in one of Maslow's hierarchies of needs, which is that we have our own home. None of us mind working across from a different, company. We all do that in our office buildings. They were always filled with different people, and you shared the elevator. I think, moving it so quickly where we were sharing kitchen space and personal space, and then COVID, to me, I just don't think we're there yet as a society.
Okay, one short question. What about your thoughts about the conversion of hotels and offices to residential?
I think easier said than done.
Yeah, I say easier said than done, but I support it. I think it's a good way to get increased housing in New York, but there's a bit of a bureaucratic angle there, and it's challenging.
We are absolutely supportive of it. We think it would be a great opportunity to create a lot of housing, affordable housing in particular, and especially in the B and C buildings, or C and D buildings, which is where repurposing them as office or hotel in locations that just don't have the demand, it would seem to be a no-brainer. We just have to get the right program in place and to create the right incentives for developers to convert them, and then you have a lot of housing that's right out there for the taking.
The real key is if you need to have easier to conversion, with the amenities and everything else, and then you also have to have tax advantages like they had when they did the Lower Manhattan conversions, where somebody had a 20-year tax abatement or a conversion right. So, you have to be creative to go on to that over there. Emerging neighborhoods. What do you like? Eli, you're like the king of the Bronx. Steve, you're the Brooklyn guy. David, you'll buy anything. Okay. So where is the next best neighborhood, Mr. Eli?
So I've acquired a few sites in Inwood, which was rezoned. So I'm very bullish on Inwood. Obviously, the rezoning now allows for higher density residential development, but more importantly, great train access with both the 8 train and the 1 train. It's on the island of Manhattan. Not that that necessarily, matters. I think, anywhere in New York that has good transportation is a great location. But I really never spent a ton of time up there, and over the last 5 years did. And it's not only a great community and neighborhood, but it's also aesthetically very beautiful. You're on the water. There's waterfront parks. So I'm very bullish on Inwood, and I'm breaking ground on 2 projects this coming year in Inwood. And I think it'll be a good opportunity to provide more housing in New York.
Steve?
I think the Gowanus neighborhood is very attractive. It's got a great location, great access to Carroll Gardens, to the 4th Avenue corridor. We love Astoria. I know that might not be the newest emerging neighborhood, but it's just
It's a great neighborhood. As they would say, my crystal apple seems relatively positive. I mean, if we spoke about a year ago, people would say, I don't want to own residential rental. Nobody's going to be renting. I have to give concessions. Okay, I can't get high enough rents. What happened? The world has changed. So hopefully we'll get rid of this COVID. We won't have another variant in a couple of months, and the world will get better. But I'm very happy that I've had Stephen, David, and Eli here today. See you next week.
Thank you.
Thank you. Thank you for having us.